All right, everyone, settle in. I want to start with a question for you. What if I told you that the most valuable things that companies like Apple or Google or even Disney own are completely invisible? You can't touch them, you can't see them, yet they are the engines that generate hundreds of billions of dollars in value. Today, we are going to pull back the curtain and learn the accounting language that makes these invisible assets visible. And let's be clear, this isn't about memorizing rules for an exam. This is about learning to see the true worth of a modern company so you can help shape its future, not just record its past.
So let's start right there with that fundamental question. 100 years ago, the answer was easy, right? It was the huge steel mill, the land it was built on, the heavy machinery churning away inside. But is that really true anymore? Think about it for a second. Is Google's value primarily in its fancy office buildings and all its servers? Or is it in that search algorithm that you can't touch or hold? Is Nike's biggest asset its warehouses full of shoes, or is it that simple swoosh logo? You can't physically grab a logo, but it commands loyalty and drives billions in sales. This shift from the tangible to the intangible is probably the single biggest story in modern business, and we're about to dive into exactly how we account for it.
And that question really gets us to the heart of what we're discussing today, valuing the unseen. In our economy, a huge portion, often well over 80%, of a company's stock market value is tied up in these non-traditional, non-physical assets. So understanding how to account for them isn't just some academic exercise for CPAs. No. This is an absolutely essential skill for any manager, any strategist, any investor who wants to get an accurate read on a company's health, its true profitability, and its potential for growth. We're going to break this whole world of unseen value into two key categories.
Now, to really understand the invisible, I think it helps to start with something we can actually touch, something we pull directly from the earth. Now, while you can physically hold a barrel of oil or a lump of coal, the way we account for them sets a really important precedent. It teaches us how to think about assets that get used up over time, and that lays the perfect groundwork for our later discussion on intangible ideas.
So from an accounting perspective, what are natural resources? Well, the definition is very precise. They are assets we physically take from their environment. And here is the keyword I want you to burn into your memory. They are depleted. Once you pump that barrel of oil out of the ground, it's gone. It's not coming back. Think about a massive mining company. Its most valuable asset isn't really the fleet of multi-million-dollar trucks or the fancy drills. It's the iron ore that's still locked away deep underground. That ore is the source of all its future money, and we have to have a systematic way to account for its value as it's being consumed.
The special tool we use for this is called depletion. And right here, this should sound really familiar to you. You all remember depreciation from our last chapter, right? How we expense the cost of a building or a piece of equipment over its useful life? Well, depletion is the exact same principle. It's just a different name for a different kind of asset. And this is all driven by one of the most important ideas in all of accounting, the matching principle. We have to match the expense of using up the asset, the cost of the timber we cut down, with the revenue we get from selling it, and we have to do that in the very same period. Depletion is simply the cost of using up a piece of that resource.
So, how do we actually put a number on this? It's a perfectly logical three-step process. First, we need a per-unit cost. So for step one, we take the total cost to buy and prepare, say, an oil field. We subtract out any salvage value the land might have left when we're all done. And then we divide all of that by the total estimated barrels of oil we think are down there. That gives us our depletion rate. Let's just say it works out to $5 per barrel. Easy enough. Step two, we just measure how much we actually pulled out of the ground this year. Let's say it was 100,000 barrels. And for step three, we just multiply. $5 a barrel times 100,000 barrels gives us a depletion expense of $500,000 for the period. That number hits our income statement and it reduces our reported profit. Simple as that.
Okay, so we've talked about assets that come from the earth. Now let's switch gears and venture into a place that's even more abstract, but in today's world, way more valuable. Assets of the mind. These are the intangible assets. They have zero physical substance, but they are often the secret sauce, the entire source of a company's competitive advantage.
So, formally, what are they? Intangible assets are things that grant specific rights and privileges to the company that owns them. A patent gives you the exclusive right to make and sell an invention. A copyright protects a creative work, like the source code for an app. A trademark protects a brand name, like Coca-Cola. And then there's the weird one, goodwill. Imagine you go out and buy a super popular local coffee shop. You pay for the building, the espresso machine, all the tables, but you know that business is worth more than just the stuff inside. So you pay a premium for its amazing reputation, its loyal customers who line up every morning, and its secret recipe for cold brew. That premium you paid, that extra value above and beyond the fair price of the physical stuff, in accounting, that is goodwill.
Now this is absolutely critical. When it comes to intangibles, we immediately hit a fork in the road. We cannot treat them all the same. We have to split them into two very distinct groups, and how we account for each is fundamentally different. Over here on the left, we have finite life intangibles. A patent for a new drug has a legal life, maybe 20 years. Its value has a clear expiration date. So it makes sense to expense its cost over that life, using a process we call amortization. But on the right, we have indefinite life intangibles. Think about the McDonald's brand name. Is there any foreseeable end to its value? Nope. So it would make no sense to just arbitrarily write it off over, say, 40 years. Instead, we do not amortize it. We test it each year for something called impairment, which is basically a checkup to see if its value has permanently dropped.
Let's focus on that term, amortization. Are you seeing the pattern here? We had depreciation for tangible assets, like buildings. We had depletion for natural resources, like oil. And now, we have amortization for finite life intangible assets, like patents. You see? They are all just variations on the exact same core accounting idea, the matching principle. We are systematically allocating the cost of a long-term asset to an expense over the periods it helps us make money. The logic is identical, only the name and the type of asset change.
Okay, enough with the definitions. I know. Let's put this into practice. Why should you, as a future marketing director, or a product manager, or a CEO, why should you care about any of this? Because understanding these concepts is the difference between making a brilliant investment and making a catastrophic one. Let's walk through a quick scenario.
I want you to imagine you're this product manager. Your team has found a total game-changing patent that could revolutionize your main product. It's owned by a tiny startup, and they want $1 million for it. You look at the legal documents, and you see the patent has exactly 10 years of life left. The big question lands on your desk, and your bonus, maybe even your career, could depend on the answer. Is this a good investment? Will buying this thing actually make our company more profitable?
Now, an amateur manager, maybe someone who skipped this class, they might just look at that top line of revenue. They see an extra $250,000 a year projected, and they think, wow, this is a home run, let's do it. But you are smarter than that. You know that the $1 million cost of that patent, a finite life intangible asset, has to be accounted for. So you do the math. $1 million cost over a 10-year life. That is a $100,000 amortization expense every single year. So the real impact on your profit, on the bottom line, isn't $250,000. It's the revenue of $250,000 minus that non-negotiable expense of $100,000. The real number, the one that your CEO and your shareholders actually care about, is a positive impact of $150,000. Now, it's still a good decision, but it's a much more realistic and defensible one.
And this, right here, is the crucial point of the whole lecture. Amortization is not just some abstract entry an accountant makes in a back room somewhere. It represents the very real economic cost of using up that patent's value over time. Ignoring it is professional malpractice. It leads to terrible analysis, awful investment decisions, and a seriously dangerous overstatement of how profitable you think you are. Understanding this one concept is what separates a savvy business leader from an amateur.
So we've covered the what and the why. Now let's make sure all this knowledge is locked in by looking at some key principles. And, just as important, some of the common pitfalls that I see students fall into every single semester. Mastering these distinctions is what's really going to set you apart. First, please do not mix up the terms. Depletion is for assets you pull from the ground. Amortization is for assets that come from the mind. Using the wrong term in a meeting is a quick way to show people you don't really know what you're talking about. Second, a huge mistake is assuming all intangibles get amortized. Remember that fork in the road. Indefinite life assets, like goodwill, are not amortized. Third, and this is probably the most dangerous trap for a manager, don't dismiss these as non-cash expenses that don't matter. Non-cash does not mean no impact. It directly reduces your net income, the number that drives your stock price and probably your annual bonus. And finally, you have to be rigorous about estimating an asset's useful life. If a patent is only really going to be useful for 5 years because technology is changing so fast, you must expense it over 5 years. Spreading it out over its 20-year legal life isn't just bad accounting, it's basically lying to yourself and your investors about how profitable your company really is.
So I want to leave you with one final thought here. The principles we've discussed today, depletion, amortization, they were really perfected for a 20th century world of oil wells and 20-year patents. But what happens next? What happens when a company's most vital assets become things like massive proprietary datasets, or self-learning AI models, or a global brand reputation that's built entirely on social media? These things don't fit neatly into our existing boxes. So the challenge for your generation of business leaders will be to answer this question. How will we evolve our accounting principles to reliably measure and value assets that are truly, completely invisible? That is the frontier of accounting, and that is where you all are going to make your mark.
Thank you.